Hey everyone, welcome back. Covered call ETFs in the US are exploding in popularity right now. High yields, steady monthly, even weekly income. But are they really the answer for long-term income investors? Today I'll walk you through my top 3 US covered call ETFs and why they made my favorites list. In my last video I shared my 6 favorite Canadian covered call ETFs. Canada has great choices, but diversifying into the US makes a lot of sense for Canadian investors, both for currency balance and for access to a much larger ETF universe. I'll also explain how I narrowed my picks down from popular contenders, and why I believe these ETFs strike the right balance of income, diversification, and sustainability. Stick around until the end. I'll show you how these can work together in a well-rounded income portfolio. Before diving in, let me quickly explain my approach to covered call ETFs and address some common criticisms. Adriano from Passive Income Channel made a great video answering a common question. Are covered call ETFs a magic tool, or just a scam? I'll link his video in the description if you want to check it out. Personally, I share a lot of his views, though I'm a bit more conservative. Unlike Adriano, I don't put all my investments into covered call ETFs, but I definitely agree with his key takeaways. Not all covered call ETF strategies are created equal. I want the best of both worlds, the yields and the total returns.
So myself personally, everyone, my quest is to find the best of both worlds. I want that consistent cash flow with with the yield, but I also want really good total returns, right? Or at least as close as possible to just holding the underlying. And now it's possible with the better strategies out there, the lightly leveraged products. So this is why I'm always on the lookout and follow the landscape closely, right?
Well said, thank you, Adriano. Personally, I focus just as much on total return as I do on yield, but that's just my approach. At the end of the day, you need to make decisions based on your goals and risk tolerance. Now let's talk about risk for a moment. Every investment carries some level of risk. The question is, which risk worries you the most? Is it the risk of underperformance? Well, so-called low-risk, fixed-income products almost always underperform in the long run. Or is it the risk of losing money in the market? Yes, stocks can drop 10, 20, even 30%. But if you avoid panic selling, history shows the market recovers over time, and those paper losses disappear. Here's the key. Markets will drop, but they also recover. The real risk isn't paper losses, but it's being forced to sell at the wrong time because you need income. That's why income-producing ETFs with solid holdings can help you ride out volatility and sleep better at night. Now let's break down which US covered call ETFs made my favorites list, and why. One of the easiest ways to diversify your portfolio is by holding broad market indexes like the S&P 500 and the Nasdaq 100. I started with the S&P 500, the backbone of the US market. My short list came down to JEPI, SPYI, and GPIX. JEPI, JP Morgan Equity Premium Income ETF. This is the big name with billions in assets and a strong track record. Management expenses is quite low for covered call ETF, 0.35%. Next up is GPIX, the Goldman Sachs S&P 500 Premium Income ETF. It comes from a well-known provider, and just like the others, keeps its management expense ratio at a reasonable level. Finally, SPYI, the NEO's S&P 500 High Income ETF. This one's relatively new but has an innovative option strategy. It pays monthly distributions and has shown strong total performance, although its MER is a little higher than the others. Let's compare distribution and total return, looking at one-year performance and current yield. First, JEPI. The yield is decent, but the price performance has been negative. Second, GPIX. The yield is a bit lower, but the price performance is much stronger. Third, SPYI. Price performance is positive, though not very impressive. The yield, however, is noticeably higher than the other two. Now, when I put total return side by side, GPIX versus SPYI, the numbers are surprisingly close, with GPIX just slightly ahead. So for me, GPIX takes the spot as my S&P 500 choice, though I'll definitely be keeping an eye on SPYI going forward. Next, I wanted tech exposure through the Nasdaq 100. My shortlist, GPQ, QQQI, and GPIQ. GPU is JP Morgan's flagship in this space. It's reliable, yield is nice. MER is 0.35%. GPIQ is equivalent from Goldman Sachs. MER is 0.35%, but yield is slightly lower. QQQI is more aggressive. It has a highest distribution from all three ETFs. What about total return? Well, JEPQ falls behind again. That leaves QQQI and GPIQ, and their numbers came out very close. I see that QQQI offers a higher payout right now, though that comes at the cost of a bit less growth potential. But since their total returns are almost the same, it really came down to my preference. Personally, I'd rather lock in higher income today. So my choice in this category is QQQI. But let me ask you, what would you prefer? Higher income now or more growth for the future? Drop your answer in the comments. I'd love to hear your take. Finally, I wanted to try a weekly paying ETF, a big trend in 2025. Weekly distributions give investors more flexibility, though some worry about higher management's costs. My shortlist: ULTI, YSPY, and YMAX. Some of these funds only launched this year, while others have recently changed their strategy. That makes performance comparisons a little tricky, since the track record isn't always long enough to draw solid conclusions. All three funds come with pretty high expense ratios, and if you only looked at their price performance, it might honestly scare you off. But on the flip side, they pay those eye-popping weekly distributions that grab so much attention. The good news? When you step back and look at the total return, the picture looks a lot more positive. For me, the winner here is ULTI. It's the strongest pick right now, though we'll see how it holds up over time. Remember, these are just my picks and not recommendations. Always do your own research and consider your personal goals before investing. So my final three are GPIX for S&P 500 exposure, QQQI for Nasdaq, and ULT as a weekly payer. Together, they create a diversified, income-driven U.S. portfolio that complements my Canadian holdings. I look at both yield and total return, but that's just my style. At the end of the day, choose based on your own goals and risk tolerance. So what do you think? Do you already hold any of these ETFs, or do you have other favorites I should look into? Drop a comment below. I'd love to hear your thoughts. Before we wrap up, a quick note on taxes. I didn't cover all the details in this video because I hold these ETFs inside my RRSP. But if you're planning to buy them in a non-registered account, keep in mind that distributions aren't always taxed the same way. Some might be dividends, some could be return of capital, or even ordinary income. So talk to your accountant before you invest. It'll save you surprises later. And if you found this helpful, don't forget to like the video, subscribe, and hit the bell so you don't miss the next one. Thanks for watching, and I'll see you in the next video.